you've put out a report talking about an investor survey and also giving some of your own calls. You don't think investors should be looking for deals in names like Pinterest, Wayfair, TripAdvisor, Grubhub, Slack. Why not?
Well, I think tech may be due for a correction. So, look, love technology longer term, but things have gotten a little bit frothy here, I think. You've had mostly PE expansion driving a 42% increase in tech stocks over the last 12 months. So we're now at a point where the economy is continuing to be weak. We got more ISM numbers out today that were fairly poor. Tech earnings are actually down year over year. That's all very normal. What's not normal is the PE is up at about 21 times and is not corrected the way you typically see in a late cycle. So as a result, we'd be a little bit careful. From a strategy perspective, we're underweight semis and hardware. We're overweight services and internet. We also today put out a list of 30 longs and shorts, which is a screen we do. It's momentum based, so it actually has a lot of semi names on the long side, a little bit more concerned about internet and some of the legacy names. So we would just be a little bit careful coming into the new year.
So if you're trying to be strategic, Gene, how do you separate the wheat from the chaff in tech this year?
Well, I think you go back to what would be undeniable truths. I know, John, you've talked about the big trends for the next decade, and I think if you really anchor your investments in what are those undeniable truths, I think it frees you up a little bit not to be as concerned about where some of the current trading ranges are. And those truths, I think there are 4 of them: wearables, 5G, electrification of vehicles, and autonomy. And I think if you would agree that those trends are a function of time before it has a significantly larger impact on our lives, then the 2 easiest plays are Apple and Tesla. And very different stories, different cultures between the businesses. But I think that despite the moves in both of those stocks, I think that there is still significant upside to those. I would also agree with Steve that some of these smaller companies and some companies that have, I think, what would be a more competitive environment, not rooted in an undeniable truth. For example, Netflix. Streaming, to me, is not an undeniable truth. Social media is not an undeniable truth. Those are the stories that I'd be more concerned about.
Gene, I want to go back to Tesla for a minute. The fact that the stock is trading just below $450 a share right now, another high today. And, of course, we got those delivery numbers as well. When you talk about upside in that name, how much higher can it actually go?
So it's an $81 billion market cap today. And the reason why I even hesitate to answer the question is you don't have hard gap earnings and EPS to really root yourself into. So the exercise is really about what should a transformative company be valued at. And I think it's much higher than $80 billion. For example, Netflix, which I think is overvalued, but Netflix is currently $145 billion. And I think that something that's having as profound of an impact as electrification and autonomy, which Tesla is doing, should be at a base case at a $150 billion company. So kind of putting that together, I think you can kind of build a case for a $900 stock here. And I think it's going to take, I just want to be clear, too, this is a good day for Tesla. It is not the day. This is not the day where the company has escape velocity, where we can mark it as a successful company forever. They still got to get the Model Y out. Elon still needs to be behaved. They still need to get China more production out of that. Germany, there's still a lot of moving parts. But I think when I think about the upside to the market cap of Tesla, over the next 3 quarters are really going to be a telling piece. And if they deliver on that, I think you could see some measurable movement higher in the stock.
Yeah, a lot of good news out of them lately, though. Steve, I wonder, you talked about this report and the screen that you put for stocks based on momentum. Does momentum mean something different coming into a year like this when you had such dramatic moves higher in 2019? I mean, just because something's been moving higher, shouldn't that mean something a little different in 2020?
It could. You know, we like to say that in tech, momentum matters 80% of the time, and valuation really only matters when you're at an extreme. I think we could argue that we're at an extreme. So having lived through 2008 and 2000, you know, you're seeing the total U.S. market cap 150% of GDP, AMD at 33 times earnings, Apple, which is a fantastic company, but I was looking the other day, and Apple's 2020 consensus number today is lower than a year ago, yet the stock has doubled. So I think we are getting into that turf where it's not just about momentum. The thing is, we still got the central banks printing money. And frankly, in the short term, that tends to help the stocks, though long term it creates malinvestment, like we saw in perhaps WeWork and Uber and some other question marks. So, we still want to be in tech over time, to be sure, but I think momentum might mean something a little bit different this year.